mental accounting. Okay. This is your ability, your propensity, your desire to allocate money for specific things. And then when you do that, you give more weight or less weight to certain pools of money, right? When in fact, the idea is it's still money either way. A dollar is a dollar, $100 is $100, whether it's in your savings account, in your investment account, or in a jar you hide under the bed. It's still $100. So all money is actually fungible. It's the same thing. But when you start putting certain weight to things, you start misallocating what it is. So like if I have a special savings where I save all my money in a jar, right? And I save that money, but I also have thousands of dollars in credit debt where I'm getting charged 20 plus or 25% interest on the credit debt. But I could pay it off with my savings jar, but I don't because that's special. And then the problem is I'm still getting raked at 20-25% a year over here when I could have just gotten rid of it. That would be one. The reverse of that would be, let's say I have 20,000 in student loans, which is a low interest rate. It's like 4.5 or whatever it is percent. I think it's like 4.5. But I say, well, I don't like having the debt, and I think that that's more weighted. So I use my savings to pay that off instead of taking my savings and investing it, where I could make more money on my savings over the long run. So I've put more weight on something that logically doesn't make sense. So in the first example, I have my special savings and I hold on to it and I don't pay off my credit debt, which means I'm getting raked in interest by my credit debt every year. On the other side of that coin, I have my college loan debt and I take my savings and pay it off as opposed to investing my savings and having my savings make more money for me. So I've actually lost money in both situations just by misallocating and not understanding that they're equal. They're not different things. As far as value money goes. The other big thing is people count into their assets, and this is just how net worth works, right? Your net worth is your assets minus your liabilities, what you own versus what you owe. So if I sit there and go, well, hey, I'm a millionaire, but most of that's in my house. Well, I'm not really a millionaire in that heightened sense. I mean, I am net worth. So I have the house, I own it outright. It's worth $500,000, and then I have all this money over here in retirement savings. Let's say $500,000. So I'm a millionaire. Well, half of it's in the house, so I can't spend that. So then what I have to do? I have to sell the house to get that money, and then I have to pay tax or whatever and all that. So I really wouldn't be a millionaire. So I'm counting money that really I shouldn't be counting. So that would be a mental accounting problem, right? Where I'm equating value that's not really existence. The other big thing with investing, you'll get like, I've got two stocks, let's say. One of them did really well the last year, made a lot of money, and one lost a lot of money. And I'm trying to figure out, okay, well, I want to sell one of these to pay off something or for whatever reason, right? I need to sell one of these. Well, most people think we'll sell the one that made the most money. Well, that's wrong. You probably want to sell the one that lost money because you can get tax advantages from that. It's also probably the one you want to exchange for something else anyway at some point. So it's just a misunderstanding of it. So I'm going to start with a little clip here where we talk about just mental accounting and how it happens. And this is the Dave Ramsey Show. And they are going to, hang on. So this is the Dave Ramsey Show. And we're going to use an example here real quick of mental accounting.
Jonathan, who joins us in Louisville, Kentucky. Jonathan, how can we help? Hey, good afternoon, gentlemen. How y'all doing today?
We are living the dream. What's going on?
Glad to hear it. Okay, so this is my situation. So I'm trying to get everything in order. I bought a house last October. The first year's coming up, so I'm trying to get everything squared away with the 15-year plan to have it paid off. But I still have a little bit of debt. I have about $8,000 that I owe on my car, and I have about $6,000 in credit card debt. So I'm thinking about just paying it all off so I can just focus on my house. And I don't know if that's a smart move or not because I don't want to, if I need an scapegoat for my savings, I don't want to, put myself in a twist at the end of the day.
Put yourself in a twist. I like that turn of phrase, Jonathan. Well, let me start with this. Do you know the baby steps that we teach?
Yes.
So we teach you to first have that $1,000 starter emergency fund and then tackle the debt, then get that fully funded emergency fund, and then we move to 3B where we save for the house. So it sounds like maybe there was some things done out of order here, and that's okay. We can clean this mess up. But how much do you have in savings?
About $35,000.
$35,000?
Yes.
How much of that is your...
So this is their 7-point financial plan. They have steps 1, 2, 3, 4, 5, 6, 7. This would come down to what we call familiarity bias, which we just covered, right? Familiarity bias would be, well, this has worked in the past, so it must always continue to work in the future. In fact, this plan does not work for everybody, and a lot of times it is detrimental for a lot of people. But I'm just going to give you an example because we've already seen now an example of a behavioral finance mistake. We're using a familiarity bias to justify the situation. We know almost nothing about this guy other than he's got some money in debt with his credit cards and some money in debt with his car. We don't know what he has in his house. We don't know if he's married, single. We don't know anything about it. But we're already developing a plan. That's a familiarity bias.
It's your actual emergency fund. How much do you need for 3 to 6 months of expenses?
Give or take $5,000-$6,000
total for your 3 to 6.
I'm going to skip.
The emergency fund.
I'm skipping because this guy. It takes him a while to figure this out. Sorry,
Jonathan. Are you telling me that 3 months expenses is $7,000 for you? Make sure that's really
not 3 months. I'm sorry, about 4 to 5 months. About 4 to 5.
Okay. Something's still not adding up. So you're saying your monthly expenses are about what, $1,200?
It takes a while to get to this.
Mortgage and everything to keep the lights on, feed yourself.
$1,350 for the mortgage. About another. What is it about? About another $1,000 for the expenses for the house. So 2, 4, 6. Yeah, that's about right. $6,000-$7,000.
Oh, so you're saying 6 or 7 per month for expenses?
Yes, per month.
Yeah, okay. So I know. We need to multiply that out to Ken's
times
point
3
to get to 3 to 6 months of expenses.
So the answer to the question is $21,000 minimum, Jonathan. That's what you're
pretty much it.
Which is perfect because you just told me you've got $14,000 in debt and you need $21,000 for the emergency fund. So to me, you make the calls as soon as you're off the phone with us. You go pay off that credit card. You go pay off that car loan, which is going to free up a whole bunch of money for you to actually pay off this house in 15 years or less. Does that sound right?
Gotcha. It does, yeah.
Okay, and I want to make sure you're also investing 15% of your income into retirement. Have you begun that?
I have, but I'm not doing 15. I'm at 10% right now, and then with the
okay. Well, let's take a break from that for a second. We'll go back to here. So the mental accounting. Okay. So he's got. I got it here. So this is Ken Coleman was the guy in the plaid, and George Campbell is the other guy in the purple with the glasses. So this is Jonathan, Kentucky. He's got $35,000 in savings. He owes $8,000 on his car. I just rough assessment. I don't know, and they didn't ask him any questions, but I'm just making a rough assessment. So let's say he owes 3 years in the car, 3.5%. It's about normal interest. So if he pays off the car normal course, he'd have paid $566 in interest over the next 3 years. That's what he'd have paid off that $8,000. Okay, so that's the interest above what he owes. The credit cards, on the other hand, he said $6,000 he owes. Well, if you owe on a credit card, typically credit cards are about 17-18%. But if you owe on it, they can jack it up, and they can jack it up to almost 30%. So I just assumed 25% interest on the back payment on the credit card. which would be about $1,500 a year in interest that he's paying. So that's a lot. Now, if it was 20 to 30, it could be anywhere between $1,000 to $2,000, whatever it is, right? But it's a lot of money per year to be paying just in interest payments, not actually paying down the principal on the card. So my personal thing would be like, yeah, let's get rid of the credit cards. You got the 35, let's knock out the credit cards. Just get that done so you're not eating that interest. The car payment, though, is such a low interest rate, I don't know what the value is of paying that off early. So now what K&G, Ken and George here, their whole thing was pay them all off now. So pay the whole $14,000 off now of the 35, right? Take 35, pay 14,000, pay off the car, the credit, 8 and 6, 14. Now I'm assuming 6% growth. It doesn't really matter. We could put it whatever we want, but over the 3 years, if they'd have done that, if he'd have paid that off, invested the 21,000 at 6%, he'd have $25,000. That would be one way to go. Now, me, Duncan, my whole thing is, well, I wouldn't pay off the car now. I'd pay off the credit cards now, and I'd invest the rest of this money, right? 29,000 that was left over here. And I'd invest that and then just pay off the car normal course. Yeah, you'd pay $566 in interest, but at that same 6% growth over 3 years, that 29,000 would be 34,536. Okay, so minus the 566 you paid in interest, you'd still be net roughly 34,000. You'd be close to 35,000, back to where you were. So this is the whole money is fungible thing, right? They're putting more value on the debt, especially the debt for the car, than on the growth of the money. That's the mistake. That's where we come back into mental accounting. They're not treating it as fungible. They're using this idea that the savings or the debt is more important than the savings, right? And I did forget to do this, but I will do this right now. So there's a casino example I like to use on this, right? So a guy, me, let's say me, I take $100, I go down to the casino, I put $100 on the roulette table, and I put it on 14, and I win, and it hits 14. 72 to 1 odds, right? So now, boom, I'm up quite a bit of money, right? 72 to 1, whoosh. That's what? That's $7,200, right? I'm like, you know what? Let it ride. I let it ride, and it doesn't hit, and I lost that money. And then I go back and call my friends, and they're like, well, how'd you do? I'm like, well, I went down to the casino, and I lost $100. That's not true. I lost $7,200. But because in my mind, that wasn't my money, it was house money, it didn't occur to me that that $7,200 was mine. So I'm mistaking, even though that money was mine in my possession, even for that, whatever it was, 20, 30 seconds, that was my money, right? Just like the debt is the bank's money, but the 35,000 is his, and it's in his possession. So it doesn't make sense for him to start throwing the 35,000 away, because that's his money. So if he pays off the debt, does that really gain him what he should be gaining? Which at the end of the day would be, he could be 3 years from now sitting on $34,536 with all this paid off. Or if he uses their method, that same 3-year period, he'd only be sitting on $25,000. So he's $9,500 richer doing it my way. But they're using a mental accounting problem where they're putting more value to the debt than the actual savings and the growth of the savings. So that's just a good example of that.